Welcome back to the IB Investor channel. In this video, we'll take a look at SBB and its Q2 earnings. Unfortunately, we don't have the most recent quarter update yet because that will happen in 5 days. So in 5 days, we'll get the Q3 report and then we'll be able to review this company even further. In this video, we're going to cover a short introduction of the company, the highlights of the quarter, the financial goals, the Q2 23 presentation, and also the summary at the end. The company was founded in 2016 and was listed shortly after in 2019. It currently holds a market cap of 5.8 billion Swedish kroners. It trades at large cap under the ticker symbol SBBB. There's also a D share here listed that you can purchase or sell, if you will. And the industry here is within real estate. Now for the share price development, and we have to remember that this company has not been listed for very long, so it listed in September 2019. As far as I'm aware, and we can see here that the share price has, climbed quite steeply here for many months here after its listing. However, there was some bumps here with some negative news here, but other than that, we can see that this company was certainly one of those companies that did benefit quite a lot from the low interest rates here in Sweden. So they made a lot of acquisitions and they purchased a lot of houses. They developed a lot of houses during this period. So there was a lot of transactions and activity in this company. And, there was a lot of media hype regarding this stock and regarding this company. There were some negative voices, but they weren't really speaking up. But then as soon as the interest rates here changed, then the sentiment changed quite a lot about this stock. And as you can see, it's just been declining ever since. And we can see here for most of the periods here, it's been, quite a big drawdown here for most of the periods. And I looked at the total returns and they pretty much look the same. So no difference here, even though you received a lot of dividends here during the years here. But if you reinvested, you're still in much of the red here, pretty similar to these figures here actually. So it's been a rough ride, especially for shareholders coming in here and, at the end of 2021 or early 2022 here. So, and this is one of the most commonly owned shares. I don't have the figures right now, but I'm pretty sure it was above 100,000 shareholders here at the Vansat, my brokers. So very sad to see that the stock, has gone down a lot, but it's not just, it's not just the stock, but rather the company as well that has not fared so well that we'll take a look at in later of this video. Now for some of the highlights of the company. So they did change the CEO here. The old CEO, Ilya Batlyan, who was also the founder of the company. It's not that he left the company per se, but he's still remaining as a board member. But he just left his role as CEO and has been replaced by a guy called Leiv Synnes, who comes from Castellum, a competitor to SBB, also a listed company, I might add. But in the quarter here, they also offloaded a lot of the JMAB shares, which is one of the most shorted stocks here on the stock exchange as well. So they offloaded many of those shares on the market. I still think they have some shares left. I think maybe 3% of the capital or something like this, but much less compared to what they had previously. They also sold some shares here in Heba, another competitor here, some shares that they own in this company. In the quarter here, they also received a lower credit rating. We'll take a look at the credit ratings in a few minutes here, but it's sub-investment grade right now, which is very bad. And this is obviously very stressful for this company right now, and a lot of focus is surrounding this, this grading, because that means that it will just be much more difficult for this company to find cheap financing. They also delayed the dividend payment here. They should have paid monthly here, but it's been postponed here until later in the year, perhaps in the next year. But before the next annual meeting, at least, it has to be decided what to do with this. And they also advised here that actually the whole company, the whole SBB company, is open for sale. So that is quite shocking news, I would say. But the whole company is up for sales, or its assets, all of it basically. So they're looking intensely here to sell off a lot of assets here just to get the finances under control here. So quite a hectic and dramatic quarter here with plenty of information to cover in this video. Now for the financial goals of this company, we're not going to dig in too much into this, but I think at least this one, the loan to value below 50%, it's currently at 52%, so they're not reaching that financial target. Also here, the interest coverage ratio is currently at 2.9 times, as we'll see later on in this video. So this is also an issue here right now. And obviously this one, they have been down ranked here, so the rating is lower than that of BBB+, which is their short-term financial goal here. In the long term, they do want A-, which is quite far-fetched as it looks right now, but again, we'll look through this later in this presentation. Now here for the ratings that they receive from the rating institutes, and we can see here that basically from S&P here, the short term here is B, which is way less than the BB+ that they want, and the long-term rating is even C here, so, and the outlook is negative, so quite bad outlook here from S&P Global. And then from Fitch, paints pretty much the same story here, but a B right now and a B- for the long term. So a little bit better than S&P, but still a B- isn't good. Also a negative outlook here, and this was quite recent as well, since 21st of August. This was quite a bit earlier, but yeah, roughly a month, I guess, not a big difference. And here we have scope as well, so I don't know what S4 means actually. I don't know so much about scope, but a BB- here from them, and it's under review here for downgrade, so it could be worse actually than this. So quite negative here. And this paints pretty much the picture of the stock as well, that this company is under financial stress, and I think it can be good to understand this, because it's no joke when this happens. Financing will be much tougher, and that's, I think, something that this company is already suffering from, which is reflected also in the share price, I would say. Sorry. So here again, some information here from the company. So they're saying a swift and thorough execution of the review to consider options that can deliver maximum value for its SBB shareholders here. And the short-term focus, as we saw, they have sold some shares in EM, which is good. They have sold properties to municipalities here, which is also good. They did invest some company here that they own called Industri Centralen Holding, that hold the Heba shares, which is a listed company here. Also exclusive discussions with Brookfield here to sell the remaining 51% of Edico. And also letter of intent here to sell properties here for 3 billion Swedish kroners. And obviously here, continuing parallel work streams to review options, including the sale of the whole company. This is huge, and this is what I mentioned before. So this is quite a shocking news, I think, for a lot of shareholders, hoping that this company can turn around, and this just, comes as a shock that, well, suddenly everything is for sales and up for grabs. So quite a big turnaround, I would say, in terms of the future prospects of this company. And also business segments here, or specific assets, as well as other strategic transactions. Sorry, a lot of S's here. So basically they're saying here as well that, it could also be the sales of, more of the assets that they hold, basically more of the holding companies, more of the joint ventures and so on that they already hold. And they've also mentioned that they want to spin off one of the housing development companies that they currently have. So plenty of options here for the company to explore and attempt to offload some of its assets here, if not the whole company. Now this company did sell and have continuously been selling off assets, so it's a little bit difficult to make an understanding of what are the numbers now. When you look at a normal company that doesn't sell off assets, you'd like to see increased volumes or increased net sales every quarter or year or something like this. But what happens here is that they've sold off so many assets continuously. So if they were just to compare, the year-over-year figures, it would look very strange. So I think that management here have attempted to make some like-for-like numbers here, so that investors and people on the sideline can understand what's happening. So here they're telling us here, so rental income increase like for like has increased by 9.5%. So the assets that they did hold, a year ago, and that they're still holding today, did increase in fact by 9.5%. And they're also saying here that the net operating income like for like increased by 10.5% here. So the underlying assets are performing quite well despite of the market situation here. So yeah, and here we can also see in the other picture here where we have the different segments here. So we can see that the community service properties, basically the social infrastructure or facilities, make up for 73% of the total rental income, so quite the big chunk here. And we can see that normal residential is only accounting for 24% here, so much less, and then other 3%. And I guess this could be like warehouses perhaps, or office buildings or something like this for other things, So and this is the red one here is and should be their core business of this company, since their name is basically community service properties. So yeah. Now for the yield of this company, and currently in the Q2 quarter here, they're telling us here that the yield is currently 4.5%, and we can see how the yield has gone up and down over the years. So here it's back in 2019 where they had 4.7%, and now in 2022 it was 3.9% for the full year average, and now currently 4.5% again. So, but what happens also with this number that you have to remember is that when they write down the value of the real estate houses, then that yield will go up as a consequence. This yield can also go up if the rental income increases for those real estates or for those buildings that they own. So the yield can go upwards in two main directions, I would say. But there is also a third option where this yield could be affected in both ways, and that could be if they're selling off assets. Let's say that they have high yielding assets that they're selling off, that produce maybe 5% on average or maybe 6% on average. That means that the yield in the future quarters will also go down as a consequence on average, because maybe the remaining real estate that they still have are perhaps producing less of a yield compared to those that they sold. So this number is quite important to follow here to see, whether it was, the value being written down or the rental income being written up, or perhaps that they sold assets that were either lower yielding ones or higher yielding ones. So this number is not easy, and I think that can be good to understand, that it can move in certain directions depending on transactions and so on. And also then for the rental occupancy rate here, we see a healthy 96.3%, so this is very good. And we can also see that over the years it's been much lower. So here in 2021 it was actually as low as 94%. So management here has actually done a good job here to improve this number, which is good to see. And we can also see that it's been trending up here pretty much since 2021 Q1 or something like this. So very good numbers here at least. Now for some more overview here, so they're giving us a market outlook for the main segments here. So this is the biggest segment, as we discussed previously here, the community service properties here. So here we can see that we have very long contracts here. The vault short for weighted average unexpired lease terms. So I would assume that this is like how long the lease is or something like this. So very long time here. And also strong tenants, it's most likely municipalities and so on who are the renters here. I guess it can be schools and similar, not just elderly homes. And then indexation of rents, and this basically means that if the interest rates go up, or let's say that the central banks are increasing the rate, so to speak, by 5%, then this company will also take a share of that interest rate increase by maybe 5% plus 3 or 4% depending on the individual contracts here. So they don't have to do anything in order to get those rental increases, but rather it's in the contracts, which is indexed linked then. So this is very strong for this type of business. However, here the residential properties here, so high demand for housing. We have a housing problem here in Sweden, so that means low vacancy and turnover. So basically, people are queuing for housing in Sweden. So that's why these are almost never empty, so to speak. But the problem in Sweden is, even though they might be saying here that they have net operating growth and rental income growth, blah, 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 it's not so high. Like the rents for these type of buildings is like, it's almost communist dictated, so to speak, so that they have to like negotiate with some, I don't know, it's just so much political stuff included in this. I think for this year it was like 4% or something on average. So they're not getting a lot of money out of these residential properties in terms of the, similar to the indexation of rents here on this side. So it's much weaker than this. So if this was maybe 11 or 12% this year, maybe this was like 3 or 4%, so much lower. And here they also have some change in population in Sweden. I don't know. It doesn't really matter, I think, in the short term for this company. Now for the consolidated income statement here. So they're claiming here that, they made some divestments here. So year over year, the number will be less, and we can see it here. 131 million Swedish kronor less. However, they are saying here that when it tickles down to the net operating income here, they're saying they're protecting it. So it's less than of a difference as to the decline for the income. And here they're saying that they had some property value decrease following high yields. So they have to, because they get audited, they have to write down some of the property value. Otherwise, management wouldn't be, doing their job, so to speak, because they still have to sign off the audits. So they were probably forced here to make some write-downs here that is equal to 5 billion Swedish kronor here. So quite a difference here in changes in value here. And also we can see here that they're telling us that they had some results from associated companies, joint venture, mainly related to the DM transaction here. So I would assume it's this number here, the 3.2 billion here. They made some sales here as well in the quarter, as we mentioned previously. So it's probably that one that they reduced a lot. And then also here, rising interest rates on the back of increased inflation, which are now seeing a tendency of decreasing. But yeah, I don't know if it's going to decrease. Like, it's the way I see it is we don't know really. But we can see here that the interest expenses and similar items are up much. So they have to pay here 222 million year-over-year difference here. So here in the latest quarter here for Q2, we can see that they spent 515 million Swedish kronor compared to 293 million kronor the year before. And then also increased pressure on the krona impacting the euro-denominated debt. Unfortunately, you can't see it here because I made some wrongdoings here when copying this. But basically, they have a lot of outstanding debt in euros. So basically, those bonds that are in euros, they become much more expensive to pay back or pay down, because when the Swedish kronor gets weaker compared to the euro, let's say that you borrow like $1 billion worth of euros or something like this, and the Swedish kronor loses value by, let's say, 50% or something like this, then you have to pay a lot more money to pay back this 1 billion euro because your own Swedish kronor is weakened. So that's the problem here, that they have seen some higher cost here as well for the interest payments, and I would assume also when they're buying back those bonds, that they have to pay more money for this, unfortunately. Now I think this is a very good overview as well. So they're telling us here, balanced financial risk requires a reduction of debt on the back of higher interest rates for new financing. So basically, the bond sellers, and the banks are telling the companies that you have to reduce your loan to value because we're not willing to provide loans to you unless you do this. So that basically means this number, that they have to reduce it, and they're doing so, I would assume, over time. But we have seen here, like going back, that it's been much higher for some periods, and it has been much lower here at periods as well. So this 52% is quite high actually here. We can actually see that it's been ramping up. So I would just assume that it's just a consequence of that they have to increase the yield of the buildings here. And they're also saying here that SBB is actively reducing its balance sheet to adapt to the new market conditions. So they're selling off the assets basically, and they have been selling off joint venture assets. They have been selling off shares that they own directly. They have been spinning off companies within this company as well to offload some of the debt and so on. So I haven't seen any companies similar to this that have done so much activity actually to decrease the loan to value here. So they're doing a lot of things, but I'm not sure if it's going to be enough. But at least you have to give them A for effort. So yeah. And the long-term ambition here of returning to investment grade rating following downgrades in a quarter. So we basically saw that for the Fitch and for the S&P there were some B ratings here right now, and that's not very good. And they need to go back to triple B minus or something at least. Otherwise it's like junk bond or uninvestable basically. So they're very stressful here to make it happen to please these credit rating institutes here. And we can also see here in the quarter, just as a quick one, that they had a 2.9 times interest coverage rate here, or ratio here for Q2 2023. So it's below their own financial targets, but this is certainly not the lowest in the market. I've seen 1.47 times. So that's the lowest that I've seen so far. So quite a difference here. It's almost twice of that of the lowest one. So this company actually looks better in that regard compared to Bonas Uden, as I remember the name. So yeah, but this number, obviously, it wouldn't hurt if this number could be higher as well. Maybe 3 times or 3.5 times or 4 times would be much more comfortable in this environment right now. Now for the liquidity, so they're telling us here that they have been reducing the debt here by more than 17 billion or 17.6 billion Swedish kroners here. So we can see that they came here from a almost 100 billion Swedish kroners situation here in Q3 for 2022, and now they have 82 billion here for this most recent quarter. And it's going to be quite interesting to see here in the next quarter, Q3, that they will be releasing here in five days to see how this number has changed, because they've done a lot of activity also in this most recent quarter that we're in now that they haven't reported yet. So it's going to be interesting to see where this number actually goes, and also how this affects the LTV here going forwards. And here we can also see the debt maturity structure. Yeah, but they're saying here as comments, actively managing the debt portfolio has resulted in a substantial like-for-like decrease in debt. And yeah, we can see it here. It's pretty clear. Reduction in near-term maturity debt increases financial flexibility. So they basically, release some cash here to pay down the debt that they have in the short term. Yeah, I mean, this pretty much paints the picture that they have been very active here in the market, and we've seen a lot of press releases, and it shows here also in the figures, which is very good. But the question is again if it will be enough. All right, some more debt figures here. You're probably already bored here, but they have an average interest rate here of 3.3% right now, but we have to remember that they're telling us here as well that like 57% of the interest-bearing debt is basically after 3 years here. So we could say something like this. So these are the ones that's covered here by 57%, and it's these these debts that they need to fix now, because if they have to refinance these, the ones that are maturing now, the 25% of the debt, the 14% of the debt, and 5%. If they have to refinance those, the average interest rate is going to be higher than 3.3. So 3.3 is the average for the whole period now. And I see now that this this page is super messy now, but for the whole period it's 3.3. So if they have to refinance any of this in the short term, especially for the less than 1 year and 1 to 2 year, that's going to mean that, you know, this average interest rate is going to go up, and it's probably going to go up closer to maybe 4, 5, maybe 6% or something like this over time if they don't fix it, because here they still have very low yields on those bonds, or maybe some bank loans as well. So if they have to refinance those, then it's going to be much more expensive to pay those interest rates going forward. So that's what they're acutely doing now, to just, you know, try to find capital, raise capital if they can, to pay down this debt right now in the short term. And here we can also see that the average debt maturity here is 3.9 years. Yeah, and we can also see here that they have a 1.6% here average interest rate debt here with maturity over 6 years. So it's basically, you know, they have to do something here about the short term basically. And here we can also see the structure, how much of the capital that will mature here over time. Now for some priorities of the company, and I think this is pretty right. So they have to increase, you know, the financial stability and liquidity, which is the top priority here, which is very good. It should be. Focus on core business, increased focus on community servicing infrastructure assets. So a background for new investors here, or maybe old as well, what they did was that they, you know, they did unfocus, if you will, and acquired a lot of, you know, residential companies and residential development companies, which is like, it's not their core business, and that's what they've done for many years here. So like Svea Bostäder, I think it's called, or something like this, and Amastan, which was also a real estate company for residential. So they, for some reason, they lost their way and acquired other residential companies, which, you know, perhaps wasn't the core business, and that's what they're trying to get back to now, that they need to go back to the community service infrastructure assets, which accounted for, like, I think it was 73% or something like this. So it has to go up to much more in the future. Also 10.5% like-for-like growth in the NOI, so basically increasing, you know, the current buildings that they have like-for-like by 10% or 10.5%, which is good. But then again, much of the like community service infrastructure assets are indexed, so as long as the interest rate is high, they will get that most likely by just automatically just having those leases in place. And also 87% of the gross debt has fixed interest rate, and the average interest rate maturity of 3.3 years here on. So yeah, anyways, I think it's a good priority, and especially number 1 and 2 I think are very important. Financials, that's all about survival, the survival right now, so it makes a lot of sense. But I think this, if the company survives, I think this is the right focus, the number 2 here, that they need to go back to the core business and live up to their name, because in Swedish, the Swedish name for this company is actually this community service infrastructure. So it's like they have to get back on track on that core business that they did really well when this company was created. And now for some fast highlights. We're not going to dwell on this too long, but basically I think that this number is very important, the loan to value. So we have to follow that one in the next quarter. This is also important, the yield, 4.5%. It's going to be interesting to see if it's going to go up in the next quarter or not. If it goes down, then we should be worried. But if it goes up, you know, good, probably, because then they're writing down the assets in a sense. Otherwise, they have to do it at some point, because some other companies have done it already. This, quite alarming, or it's not super alarming, but we need to see this going up. So 2.9 times interest coverage ratio. It's not the lowest, but it's certainly not the highest. I remember Sagax having like 6 times, or maybe it was 6.5 times or something like this. So there are other players in the market that has much higher ratios here. And here we can also see the company overview of the value of the different countries here. So Denmark here being the smallest one, followed by Finland, and then Norway, and then Sweden. And then here we can also see the segments, how much they're worth. I actually would have figured that this was worth more, the community service properties, since I remember the figure for the, I think maybe it was the rental income was like 73%, something like this. So I would have assumed it was kind of similar, but it seems that they're making more money than from this one, it seems. And this was like 3%, and now it's like 5%. So yeah, I guess it's just interesting numbers. So yeah. Now, we're not going to dwell on this topic too long, but there's also been a short thesis about the company, and there's a good report on this if you search for Viceroy with a C and SBB or Samhällbyggnadsbolaget, then you can, read all the reports on your own, because I think some of them are quite relevant still for this company, and there's been a lot of, discussions and actually some wrongdoings that has been found and corrected by this company. So for example, I think they released a report a year ago or so that the accounting and specifically the cash flows, whether there were some inconsistencies between the balance sheet, I think it was, and the cash flow statement, and the numbers didn't make any sense when they looked at those together, and SBB then admitted some wrongdoings here, some errors actually in the annual report, so they actually had to update it and correct it. So not everything has been falsely claimed, so to speak, from this short thesis company. So that is also put a lot of pressure on the share price, obviously, because if everything was bogus, then obviously the share price probably would have recovered much sooner. But there has been some wrongdoings from the previous CEO, and as just as a segue, in terms of the old CEO. The old CEO also promised, 100 years of dividend raises, and there was a lot of promise about the company that, it should withstand for more than 100 years and blah, blah, blah. So, there was a lot of wrongdoings, I think, a lot of claims from the previous CEO that, in hindsight weren't good, from him to say, because a lot of those were just wild and crazy and just speculative, Nobody can promise, dividend increases for 100 years, not even Warren Buffett, So there has been, a lot of history where this company has been, under fire and with some substance, I would say. Not everything was, untrue, but many things were actually probably true. And then we also have, the capital structure of this company, where they use something called hybrid capital. I think it's something that is only used in Europe. I can't explain it too well, but it's basically like 50% of the debt that you acquire if you use hybrid capital is like you pretty much can say that it's like your own capital or something like this. So the hybrid capital is used by this company, and it just messes up the value of this company, because if you use a lot of that hybrid capital, which I think that this company has done in the past, the company's balance sheet may look better than it actually does, because it's actually debt, half of it, but you can report it as your own capital. So it's kind of strange. I can't explain it very well because it's super technical. Maybe somebody with accounting education here can maybe do a better job compared to me, but it's good to know that it has been used in the past. I don't know if they still use it, but I would assume that they still have some hybrid capital still left on the balance sheet, but it just messes things up because it makes it much more difficult to understand the loan to value if those kind of numbers are tossed around in the balance sheet in there. Now this is it for this video. It's one of the longer videos that I've actually ever made here on YouTube. But I thought that this company is very exciting to watch. I have previously owned this company, and I just think that the current management here, Leiv Synnes, I think he's doing much of the right things. I think that the priority is right. Sell off the assets to the best of their ability. They're probably going to have to raise some cash as well, or some equity from the joint ventures and the other companies, or the main company as well, if they can, because that would give them some breathing room, to fix the finances here in the short term. But other than that, I think that the presentation that they provided us shareholders was pretty solid, I would say. Then that's not to say that they don't have challenges. They obviously do. It's going to be very interesting to see how they move in the next quarter here, because we had a lot of KPIs here that we can follow up for the next quarters and see how they've done, how they performed. We know that there has been some press releases on some of the transactions happening here with the Edico, with Brookfield. So it's going to be interesting to see if they can shed some more light on that transaction, and also to see exactly how the overall business looks like right now. So very interesting company, and as I said previously, it is one of the most owned stocks on the Swedish stock exchange as well, at least according to my brokers. So I think a lot of people are invested in not just the stock but also the story about this company, because there's a lot of drama surrounding this company. So super interesting company to read about and get more knowledge about, certainly. Anyways, thank you very much for watching. Please hit the like button and subscribe for more content. Bye bye.